think that's right. We're in I think we have
Well, good morning, everyone. When I walked into the room a few minutes ago and saw all of the cameras, I thought, boy, they're here to cover me. Then I realized that the chairman of the Federal Reserve was going to be here and understood the reason for all the cameras. But, Mr. Chairman, thank you so much for coming. I have just a few brief comments to make before we get started. I'd like to welcome everyone to the second meeting of the President's Advisory Panel on Federal Tax Reform. I have prepared a written statement that will be entered as part of the record, but in the interest of time, I will make a few brief announcements and give a short overview of today's meeting. At our first meeting, I mentioned the importance of making sure the public knows about our activities and has a chance to provide input. I announced our website and made a specific request for public comments. Since then, thousands of people have visited the site, and taxpayers from every part of the country have written in to share their experiences and to express support and encouragement. And we look forward to further input. Next week, on March the 8th, we will hold our first meeting outside of Washington, D.C. in Tampa, Florida, where we will examine the impact of our tax system on business and entrepreneurship. The following week, we will travel to Chicago, where we will explore the influence of the tax system on important taxpayer decisions. We will be announcing additional meetings shortly. Today's meeting will build upon the excellent introduction to the current tax system we received at the first meeting and will put the problems of our tax code in sharper focus. We are honored to have with us today Chairman Alan Greenspan, who will explain how the tax system restrains our economy and how we would benefit by taking steps to simplify our tax code. We're also privileged to hear from James Baker, who was Secretary of the Treasury during the 1986 tax reforms. He is one of a number of people who were involved in the previous tax reform effort who will share their views with us over the next several months. Commissioner Mark Everson will describe the tax code from the viewpoint of the tax administrator and will explain how the IRS copes with the tax code's immense complexity. We also have two panel discussions that will focus on the problems and the complexity and also the alternative minimum tax. And I will introduce the witness for these panels later on. Today's meeting, along with upcoming meetings across the country, will lay a solid foundation for a thorough understanding of the problems created by our tax code. We intend to build on this understanding in making recommendations for a tax system that will live up to the expectations of the American people. And Senator Breaux, did you say you had a comment to make?
Yes, Mr. Chairman, thank you very much. I just want to say that after the first meeting to all of our members, as the members of this panel have got to know each other, and both by reputations of the outstanding panel members and also the personal interaction that the committee has been able to engage in under your leadership, Mr. Chairman, I just want to say that I'm very optimistic about the potential for this panel to come up with a recommendation that is unanimous or as close to unanimous as it possibly can be. Many of us have served on previous panels and commissions, and many times you can sort of determine what the outcome of the panel or the commission is going to be by the people who are on it because of the strong political positions that they have previously taken, in which their biases were very evident and very well known. I think that this panel, the members have, I think, the potential to work very well together. I think we come to this position all dedicated to meeting the charge of the President, and just want to say that under your leadership, I'm very optimistic that we will be able to work very well together and reach a consensus agreement. Thank you.
Thank you. Thank you. And with that, Mr. Chairman, we'll look forward to your comments.
I think it's coming through now. Oh, no, it's not.
There we go.
That was mine. Hello, hello.
No. We need some help here. Try the other microphone just to see if it...
That's why you're the chairman, obviously. So.
Become chairman of anything, you forget how to do it. Okay, that'll do it. Thank you very much, Mr. Chairman, and members of the panel. The President has clearly assembled a very able panel to address an issue that is both important and exceptionally challenging. The U.S. economy is the world's most dynamic and flexible, and the federal government system for raising revenue must not hinder the processes generating that economic success. However, since the exemplary 1986 reform, the tax code has drifted back to overly complicated and burdened by higher marginal rates and by many special provisions that have undesirably narrowed the tax base. Changes since the 1986 Act have been largely incremental without the appropriate all-encompassing context that broad reform brings to the table. It's perhaps inevitable that every couple of decades, drift needs to be addressed and reversed. I believe some useful lessons can be learned by examining earlier systematic reforms of the tax code, such as those of 1954, 1969, and 1986. Among those reforms, the 1986 effort is widely regarded as having been the most successful of the post-war era. This success was achieved in large measure, I believe, because the reform hewed to an explicit set of principles. I'm not suggesting that today's reform should follow the specifics of the 1986 reform. Both the economic and fiscal conditions, as well as the existing state of the tax system, have changed in important ways since that time, and some aspects of the framework that worked well in 1986 may be inappropriate today. Nevertheless, I believe that a number of the principles underlying that reform are still applicable. Defining feature of the 1986 reform was the broadening of the tax base and the lowering of tax rates, and it is widely believed that these changes enhanced economic efficiency. High tax rates, whether the base is income or consumption, exacerbate the distortions that taxes invariably create. Moreover, distortions arise when similar activities are subject to different tax treatments. Such distortions reduce economic efficiency as households and businesses respond to the tax code rather than to underlying economic fundamentals. Lowering tax rates by broadening the tax base generally will reduce the costs of such distortions, which are approximately proportional to the square of the tax rate. Over the years, economists have disagreed about the size of the efficiency gains that might be achieved from a broader base and lower rates. There can be little doubt regarding their positive effect. The 1986 reform also strove to achieve a measure of comedy in the tax code by treating taxpayers in similar circumstances in a roughly comparable manner and by maintaining progressivity in the tax system. In addition, the 1986 reform broadly applied the constraints of revenue and distributional neutrality, which appear to have facilitated bipartisan coalition building. Setting rough distributional neutrality as a rule of the game limited the number of losers created and likely made sacrifices in the name of efficiency easier for different groups of taxpayers who knew that losses would be relatively limited. Of course, public views about the fairness of proposed changes to the tax code will surely play a significant role in the current debate, and these views will be driven by perceptions of the fairness of the current tax system. The standards by which the public judges fairness are deeply rooted in judgments of whether and which incomes are the consequence of individual effort. Contours of economic policy since the nation's founding have closely followed changing standards of fairness over time. Simplification of an overly complex structure was another important accomplishment of the 1986 reform. Unfortunately, tax code drift since 1986 has evolved to a point where taxpayers are again confronted with great complexity. Indeed, an individual taxpayer may have difficulty even knowing his or her marginal tax rate because of the overlapping web of deductions and exemptions and the provisions that attempt to limit those deductions and exemptions. And many taxpayers are now required to compute their liability under two systems, the regular income tax and the alternative minimum tax. Such challenges also affect lower-income households who face the complexities of the Earned Income Tax Credit. A simpler tax code would reduce the considerable resources devoted to complying with current tax laws, and the freed-up resources could be used for more productive purposes. Thus, greater simplicity would in and of itself engender a better use of resources. Principle that I believe is important now, but appears not to have weighed so heavily on those involved in the earlier reform, is predictability in the tax code. By this I mean creating a tax system in which households and businesses can look into the future and have some reasonable degree of certainty about the future tax implications of decisions made today. Just as price stability facilitates economic decision-making by limiting the potential distortions from unanticipated changes in the price level, some semblance of predictability in the tax code also would facilitate better forward-looking economic decision-making by households and businesses. Given the expertise on this panel and the ultimate responsibility of the Congress and the President for the tax system, I would not presume to suggest the best specific path for reforming the tax system. However, past experience does suggest that as the panel's work gets underway, one of the first decisions that you will confront is the choice of tax base. Possibilities include, of course, a comprehensive income tax, a consumption tax, or some combination of the two, as is done in many other countries. As you know, many economists believe that a consumption tax would be best from the perspective of promoting economic growth, particularly if one were designing a tax system from scratch, because a consumption tax is likely to encourage saving and capital formation. However, getting from the current tax system to a consumption tax raises a challenging set of transition issues. In 1986, tax reformers considered a consumption tax base, and despite the arguments in favor of such a system, they decided to enhance the comprehensiveness of the income tax system then in place. Circumstances are different today, and the right choice will require assessing anew the trade-offs between complexity, fairness, and economic growth. The choice of the tax base and other provisions of the code must also be taken in light of coming demographic changes. I believe that as the baby boom generation begins to retire in a few years, it will become increasingly important for the nation to boost resources available in the future through greater national saving and enhanced incentives for participation in the labor force. Tax system has the potential to contribute importantly to those goals, and at a minimum, tax reform should not hinder the achievement of those objectives. Finally, fundamental, thoroughgoing tax reform will require trade-offs among competing objectives and will create both winners and losers. In the past, these difficult choices were facilitated by bipartisan cooperation. In the 1954 reform, congressional support was bipartisan and President Eisenhower signed the legislation. In the 1969 reform, efforts were started under President Johnson, but were completed during the Nixon administration. Similarly, in 1986, President Reagan worked with Democratic congressional leaders to see reform through. I'm confident that this panel can lay the groundwork for another historic reform and can get this process started off on the right foot. Thank you for the opportunity to share some thoughts with you today I look forward to the results of your deliberations. And Mr. Chairman, I look forward as well to your questions.
And thank you, Mr. Chairman, and appreciate your input. Let me just, for the benefit of the panel, I'm going to turn to Senator Breaux for the first question, and then to Tim Uris, and we'll work our way down the panel. So with that, John.
Thank you, Mr. Chairman, and thank you, Mr. Chairman, for giving of your time to be with us this morning to talk about the task of this panel as we reach a recommendation to the President. On page 4, you talked a little bit about the options and that are available to us. And looking at the concept of reforming the existing income tax system or looking at a consumption tax, or you mentioned perhaps a combination of both. It seems that many of the countries that are developed countries have sort of a combination of both a consumption tax and with an income tax. Some would argue that the choice we have to make is a recommendation for one or the other. Some argue, on the other hand, that you could do a combination of the two, as many other countries have done. Do you have any thoughts about the viability of doing a combination consumption tax, income tax, versus just one or the other?
Well, Senator, we actually at the moment have a somewhat mixed system because, remember, we do have a number of provisions in the tax code which lower the rate on savings. And obviously, to the extent that you're lowering the rate on savings, you're essentially placing it on consumption. So in that regard, we do have a mixed system. And I would suspect that probably that may be the best route to go. In other words, don't try for purity in either area, because I would suspect that the opposition that would arise would probably make such a structure infeasible. So there's nothing inherent in the way one imposes taxes that you cannot use both. Any tax increase, as you know, inhibits economic activity in one way or another, and we try to construct a tax system to raise the revenues we need in a manner in which the impact on economic activity is least. And having two types of fundamental systems from which to work to choose a menu, so to speak, of taxes strikes me as opening up a much broader way of solving this a dilemma which cannot be pushed aside, namely that whatever you tax you will get less of, and if you're taxing the economy, regrettably, that's what inevitably happens.
Follow up, are you confident that you can design a type of consumption tax that would be fair to moderate to lower income people?
You can always construct a degree of, you can always put a degree of progressivity into a tax system. Probably the simplest way is to exclude certain items from the tax which tend to be disproportionately consumed in the lower brackets. You obviously could also do it with brackets. The big problem you have with the consumption tax is, what do you do about the consumption that is financed by old capital that has previously been taxed? And this is an issue which I think bedeviled the 1986 Commission and ultimately led to essentially an abandonment of trying to resolve that issue.
Thank you, Mr. Chairman.
Tim?
Thank you very much, Mr. Chairman, and I wanted to follow up on what you've been discussing by asking this question. In our last meeting, a panelist, one of our witnesses suggested that one reason to create a separate consumption tax via something like a value-added tax was the need that he felt to raise additional revenues down the road, and this would be an easy way to do that. Others have said that a problem with creating a separate consumption tax along with our current income tax would be that it would reduce pressure to make changes in some of the entitlement programs that ought to be made. Do you have a view on that debate?
I think you could find witnesses who will give you exactly the opposite answer on both those questions. And the reason is that there are obviously those who believe that what's wrong with a value-added tax is it's too easy to raise revenue, and hence you will tend to raise more than you should in the context of the needs of the society, and in the process suppress economic growth. I don't think none of these are easy, and the mere facility of raising taxes shouldn't be a criterion. And above all, we shouldn't try to hide what we're doing. A lot of these particular proposals is that somehow you will slip in an extra $20 billion and nobody will notice, and that tax incidents somehow or another will elude people, and if you bury it most deeply into the structure of the exchange rate system, rather into the system of exchange of goods and services, you will somehow make it invisible to all the people on whom the incidence ultimately falls. I don't doubt that that happens, and I don't doubt that we choose to do it. I just think that's not what an open democratic system ought to endeavor to do.
Thank you. Mr. Rosati?
Yes, thank you, Mr. Chairman. I wanted to follow up on one intriguing item in your testimony about predictability. So this has been, even in past reforms, given less emphasis than it should, and I can see the importance of that. Could you give some ideas on how predictability might be achieved better than we have in the past?
Well, remember that the predictability that is most important is the predictability of business investment. Clearly, all investment refers to expectations about the future, and forecasting is tough enough without increasing uncertainties. To the extent that you have an uncertain tax structure, you increase the variance of the forecast, and accordingly raise the real cost of capital, and one must presume lower capital investment and lower growth and standards of living. You can raise similar issues in the household sector, but they're probably not as critical because households are not investing in the longer term with as much uncertainty as is the business community.
But how would it be, what are some ideas on how more predictability might be achieved?
Well, predictability is largely achieved by trying to get the right tax structure in and then fending off all the endeavors on the part of others to chip away at it as the years go on. The obvious case is what's been happening since 1986. I thought that the Michelson-Morley experiment in the 19th century demonstrated what the speed of light was. I was mistaken. The speed of light is obviously even faster. It's not as fast as the response that occurred after the 1986 Act.
Bill?
Thank you very much, Mr. Chairman, for your testimony. Thanks also for your great service to this country over many years.
Thank you, Congressman.
My question was essentially the same as Commissioner Rosati's, related to predictability, and you've already answered that. I guess we do the best we can here and pray that the future executives and Congresses are slightly more resistant to change than they have been in the past.
I don't know. As a matter of fact, if I had to find the answer to that, I probably would have called you because you've been around much longer than I in this particular area. It is a very interesting question. I don't perceive it, but I'm not sure that that's a valid inference.
Thank you very much.
Thank you for joining us today, Mr. Chairman. One of the issues that economists frequently wrestle with when trying to figure out how changes in the tax treatment of business investment or of interest deductibility or related issues would ultimately play out in their final incidence, what their final incidence would look like, is how those changes might affect nominal interest rates in the economy. Given the size of the U.S. corporate sector, the size of the U.S. household sector in the global capital markets, how would you urge us to think through the possible equilibrium effects that we might see on interest rates from some of these changes?
I mean, from the tax code?
Yeah.
I'm not sure that we ought to be focusing on a number of elements such as interest rate structure in formulating the tax code. I think it's difficult as it is. There are obviously other much more profound forces involved in determining the real interest rate and the inflation expectations and nominal rates and the like. And while I'm not saying that the tax code obviously doesn't affect interest rates, I mean, clearly the structure of the degree of integration, if any, or elimination of the double taxation of dividends has an impact, and clearly the extent to which the various structures of taxation can have an impact on the leverage in the system will have impacts. I don't think, however, that in formulating the tax code, it's wise to try to include measures which affect that. And the basic reason is not that you can't improve, you cannot get a better system, and I think you can. I mean, in other words, clearly there are the whole issue of the deductibility of interest and the non-deductibility, or at least now partial non-deductibility of dividends, clearly affects the leverage in the system, and it will affect interest rates. And one could argue that it's an important issue. But aside from the very broad question, which I've raised in other fora about the desirability of eliminating the double taxation on dividends completely, I would be hesitant to do it. I would be hesitant to use the tax code too generally for other than this general integration process. There are too many complexities in making judgments, as far as I can see.
Thank you.
Beth?
Yes, thank you, Mr. Chairman. As you know, we've had for some time in the tax code provisions to increase individual savings, employer-provided savings accounts, IRAs, backloaded IRAs. There are more proposals. It's part of the complexity analysis that I think we have to engage in. It's made complicated by the fact that we're not very sure what effect those have on savings rates, and we do know that some of the revenue loss may affect the deficit now and in the future. I wondered if you had a reaction to some of those savings incentives in the tax code, and if you might provide us with some principles as we go forward to analyze those provisions.
This is a difficult issue because the critical facts are in dispute with respect to the impact. There are those who have argued demonstrably with fairly impressive sets of data that 401ks, for example, do add net to savings in the society. And as I recall, the data are largely coming from various different types of panels and the like. There's another group who finds no such evidence and would argue that essentially what is happening with 401ks is merely a shuffling of savings from one part of one's asset system to another, and that there's no net increase in savings. It is probably, however, indisputable that even if there is a shift and no new net savings, you are indeed, by moving regular savings into 401ks, enhancing retirement accounts. And that, especially in the context of the discussions we've all been having the last few weeks, relevant to retirement funding and the like, is clearly something which is desirable. So I would say that, yes, we do lose revenue from 401ks and IRAs, and obviously that's the general purpose of what we do. But I would suspect that it's probably a useful thing to do. And at worst, it does very little harm and does cut the cost of taxation on capital, which in my judgment is a positive for economic growth. So all in all, I think that those particular vehicles, even given the disputes about the actual impact, are something which we should continue to pursue, in my judgment.
Thank you, Mr. Chairman, for spending some time with us this morning. I want to stay on the savings topic for a minute, but take a different angle with my question. You talked a lot about the need to have our tax code be more stimulative for savings and less stimulative for consumption. And also, obviously, a lot lately you've been talking about the need overall as it relates to global imbalances for our country to stimulate savings more. How far do you think a change in the tax code here that would stimulate savings more would take us on that path to easing some of these global imbalances?
I suspect very little. In other words, the forces which are driving global imbalances as a general proposition are far more deep-seated and structural issues with an economy than the elements of the tax code. I do not deny that you can find ways to alter the tax code to impact on, say, the current account deficit or the balance in general. My suspicion, however, is that the efficiency effect of doing that is probably a very bad trade-off, in the sense it's far too costly in either complexity, loss of efficiency, and potentially even revenue to get a meaningful impact on the overall current account balance.
Thank you, Mr. Chairman. Thank you, Mr. Chairman. A primary rationale for increasing saving rate is that we expect that it will have some impact on growth rates down the road. In order for that to happen, there has to be some link between domestic saving and investment. So what do you think we can infer about the effect of saving on investment, given that we live in an international capital market?
Well, let's remember that the mere existence of savings doesn't create the investments. And the issue is, in order to have the investment, you do need a form of financing. And in this country, what we have done to finance domestic investment is to have, at this stage, almost 6% of our GDP in terms of foreign savings, which we're borrowing to finance what we are doing. So clearly, anything which enhances domestic savings would make it, would give us greater flexibility in financing investment. But that still doesn't address the question of what are the incentives that are required in order to maintain capital investment. And in my judgment, the issue fundamentally is to have as low a tax as one can on capital investment. And one of the reasons why we try to do that is it's fairly evident that capital investment is a critical part of the creation of gains in labor productivity. But let's remember that there are other elements in the tax system here which increase labor productivity, which don't have anything to do with physical capital investment, because as you're aware, approximately at this stage, almost half of gains in labor productivity are created by what we call multi-factor productivity, which is the amount of productivity gain which is attributable to all the technological and innovative activities other than those literally involved with the physical capital asset which we employ for productivity gains. So anything that enhances investment, or put it the other way around, any tax which reduces the incentives which are otherwise there in the most minimum way is the best tax. In other words, you will not create a tax which will enhance capital investment, because in that regard, zero tax is the best tax. So it's a question of what is the least that one can apply in order to get the maximum investment. There are a lot of other issues with respect to all sorts of elements within the tax code, the investment tax credit, forms of depreciation charges, tax credits of all sorts. All of these alter the optimum path of capital investment, and the less of those we have, in my judgment, the better off we are, because what taxes do is either suppress investment or they shift it. And in both instances, unless you have monopolistic structures in the marketplace, you are creating a less than optimum capital structure.
Mr. Chairman, let me raise a question with respect to the consumption versus income tax in this context. One of the things that we will be thinking of as we go through these next several weeks and months is how much emphasis to place on consumption versus income. And since consumption is such a driving force in our economy, do we need to be concerned about placing too much, if you will, tax on the consumption sector, that we, in essence, drive down consumption, slow down the economy? I would assume that that would be short-term. And if that's a reasonable premise to raise, is there a role for the Federal Reserve in that short-term period?
Well, there's always been disputes over the generations about the issue whether
Is that something we need to be worried about?
Recess. Recess.
As you can see, this event was interrupted by a fire alarm, and Fed Chairman Greenspan was dismissed. We move forward a few minutes now to hear from former Treasury Secretary James Baker on how the tax code might be simplified. This portion's about 35 minutes.
Our federal tax system is unnecessarily complicated, making much of it incomprehensible to anyone but specialized accountants and attorneys. It is financially burdensome to the millions of taxpayers who must comply with its Byzantine provisions. It fails to reflect adequately the increasingly integrated nature of the modern global marketplace. It is crippled by special interest loopholes that both drain revenue and undermine public respect for the law. And perhaps most importantly of all, it is often counterproductive in terms of promoting our vital national goals of higher investment, employment, and overall growth. In short, our current federal tax system is in acute and overdue need of a comprehensive overhaul. And that's why I welcome this opportunity to speak to this panel. If you will permit me, I will focus on what I see as the broad objectives of tax reform. You will be speaking with many experts much better qualified than I am to discuss such complex and sometimes contentious matters as the alternative minimum tax, or eliminating or reducing the double taxation of corporate income. Instead, I will stress certain general principles that I hope will drive your deliberations. I will also touch on the successful efforts of the Reagan administration to forge bipartisan support for major tax reform in 1986. I suspect our experience then may prove useful today as this panel goes about its work. The executive order creating the panel summarizes the fundamental principles of any comprehensive tax reform. In it, President Bush calls for proposals that would simplify the federal tax code, promote fairness, and encourage economic growth. All of these objectives, of course, are critical. This morning, however, I would like to stress the third objective, fostering broad-based economic growth. Indeed, I see tax reform as a vital complement to President Bush's efforts to lower marginal tax rates, reduce disincentives to savings and investments, and abolish the estate tax. I supported the President's 2001 and 2003 tax cuts for a very simple reason. And that's because we have tried deep and broad-based tax cuts before under President Reagan, and they worked. The tax cuts of 1981, I think, laid the groundwork for nearly 2 decades of economic expansion, interrupted by only 2 quarters of negative growth at the time of the 1990 to 1991 Gulf War. And I am convinced that President Bush's tax cuts, particularly if they are made permanent, will provide a similar foundation for the long-term growth of our economy. Let me now say a word or two about the most sweeping overhaul of our federal tax system since the enactment of the modern income tax in 1913, and that was the Tax Reform Act of 1986. As you know, as President Reagan's Secretary of the Treasury at the time, I was deeply involved in this effort from inception to enactment. As passed into law, the tax reform of 1986 lowered the top personal tax rate from 50% to 28%, reduced the number of brackets from 14 to 2, curbed and eliminated deductions and loopholes, and completely removed 6 million low-income Americans from the tax rolls. But regrettably, this sweeping reform proved transitory, as subsequent decades saw marginal rates raised and some deductions and loopholes restored. Nonetheless, the act did represent genuine reform of a system that had theretofore seemed impervious to fundamental change. So we might ask, what are the lessons of that experience in 1986? Well, first, I think, and most important lesson is probably that presidential leadership is critical. President Reagan made tax reform the centerpiece of his second-term agenda. He highlighted it in his 1984 State of the Union address, and he stressed it during his successful re-election campaign later that year. Throughout the long and difficult process leading to congressional passage, those of us at Treasury could count on the President's commitment to reform and his willingness to expend political capital to advance it. Let me add that presidential leadership also serves a broader purpose, one that I think this panel shares, and that is educating the public on the issue of federal taxation, an issue that excites more emotion normally than it does sober consideration. Second, that bipartisan support for tax reform can be decisive. The easy majorities by which tax reform eventually passed the Congress in 1986 bear witness, I think, to its broad appeal across the political spectrum. We in the Republican administration look to influential Democrats, such as House Ways and Means Chairman Dan Rostenkowski and Senate Finance Committee member Bill Bradley, as full partners in our effort to overhaul the tax system. By doing so, we managed to avoid politicizing the issue and instead fostered a spirit of cooperation that was instrumental to our ultimate success. Bipartisan support would seem less important today than it did in 1985 and 1986. Then, of course, the Congress was divided with a Democratic House and a Republican Senate. Today, of course, Republicans control both bodies. But, Mr. Chairman, I nonetheless believe that the broadest level of bipartisan support is still desirable, if only to avoid plunging the debate over reform into partisan acrimony. And this panel, with members from both major parties, I think is an important first step in that direction. Third principle, revenue neutrality is essential. By insisting on strict revenue neutrality in 1986, we imposed discipline on the reform process in 2 ways. First, we were able to remove contentious questions of overall revenue levels from the discussion. Second, we generally succeeded in limiting efforts to riddle the proposal with tax breaks for special interest groups, since each and every loss in revenue would have to be offset. I understand that revenue neutrality is a rather more complex issue today, with such critical matters as congressional extension of the 2001 and 2003 tax cuts still outstanding. As I've mentioned, I strongly support making those cuts permanent. Nevertheless, some form of revenue neutrality will be required if the process is to force the tough trade-offs necessary to achieve genuine reform. Fourth and finally, I think a pragmatic assessment of political reality can give reform momentum. If you will remember, there was a November 1984 Treasury Department proposal for tax reform which limited the home mortgage deduction to principal residences and totally abolished the itemized deduction for state taxes. That proposal went nowhere because it failed the test of political reality. Maintenance of the full deduction for home mortgage interest was one of the foundations of our later successful efforts. President Bush has made clear that he believes any reform should recognize the importance of home owning and the importance of charitable giving. And so I would urge you to seriously consider these suggestions. I realize that it is not exclusively the job of the panel to prejudge the political compromises that are necessary for final passage. But a basic recognition of political reality will help you shape recommendations that I think could survive the legislative process. This will still leave room for you to be bold and to be broad-ranging in your proposals. Consider, for instance, a shift in the federal tax base from income to consumption, an approach put forward by many, but of course which many also consider politically difficult. While I'm no expert on the subject, Mr. Chairman, I believe that consumption-based taxation has very much to commend it. And if properly crafted, I think a consumption tax could certainly meet the fundamental criteria of being simple, of being fair, and of being pro-growth. In conclusion, let me again commend this panel for taking up the President's challenge to build a better federal tax system. I don't have to tell you that achieving significant reform is not going to be easy. Special interest groups and sheer institutional inertia are going to bedevil the process every step of the way. But I think our experience in 1986 demonstrates that comprehensive tax reform is indeed possible. I'm convinced that the President of the United States is prepared to offer his firm leadership. I also believe that the endorsement of such respected former senators as the chairman and vice chairman of this panel will carry great weight with members of Congress on both sides of the aisle. So, of course, would a unanimous report by this panel. You bring an impressive wealth of expertise and experience to these deliberations, and your willingness to serve as members of the panel is evidence of your deep commitment to good public policy. You will need all of that experience and all of that expertise and all of that commitment in the weeks and months ahead. I applaud you for taking up the daunting challenge of tax reform, because it is a daunting challenge, and I wish you every success as you embark on your critical work. Above all, I would urge that you keep your eyes on the prize being the creation of a simple, fair, and pro-growth federal tax system that, in the words of President Ford's Treasury Secretary Bill Simon, looks like something designed on purpose. The American taxpayer, Mr. Chairman, demands and deserves no less. Thank you very much.
Very much for your comments this morning. They will be very helpful, and I'm sure that we will be thoughtful of those as we go forward. I'm now going to look to the various panel members for their questions, and we'll start with Ed Lazaire.
Thank you, Mr. Secretary. I'd like to touch on two topics that you addressed. One was complexity, and another was economic growth. And I wonder if you could discuss the link between the two. We know that complexity is a very significant issue. Some estimates have the cost of complexity to tax code being something like 2% of GDP, and that's an enormous number. Do you believe that elimination of the complexity will have an effect on economic growth, and if so, through what mechanism?
Well, I would think, sir, that simplicity or greater simplicity would enhance economic growth by simplifying or reducing compliance cost. The more complicated the tax code is, the greater are the costs of compliance. The simpler it is, the less they are. The less those costs are, the greater is the potential for economic growth.
Mr. Secretary, I want to talk about the notion of making this unravel-proof, as I've heard the term used, and it's hard not to think about this with a sort of air of potential futility and the sense that 20 years from now there'll be another commission formed to go through this process again. So given your involvement in 1986, maybe you could share with us anything you look back on that you might have done differently to make this a little stickier, lessons that we can use as we develop our proposals.
Well, Ms. Garrett, I think it's Ms. Garrett asking the question.
That was Liz Ann Saunders.
I don't have a solution to that. If we'd had a solution to that in 1986, we might not be having this hearing today, because the 86 tax reform might not have come unraveled through the creation by Congress of new loopholes and deductions and the increase by Congress of the top marginal rates. I don't know how one Congress can bind another, or better put, I suppose, I don't know how one Congress can bind a future Congress. So I don't know how you make it unravel-proof, if that's the right word to use. I think that you're always going to be faced with the prospect that that succeeding Congresses will want to address the tax code. One of the most important things, I think, in promoting growth and simplifying is for the taxpayer to have some assurance that not every new Congress is going to deal with the tax code, but the temptations of doing so are extraordinarily great. So I'm afraid I don't have a solution to that problem. I wish I did. If we'd had it in '86, I think we would have tried to put it in place.
Next member of the panel is Elizabeth Garrett.
Thank you, Mr. Secretary.
Sorry, I thought that was Ms. Garrett that was asking that question, because I can't.
I'll try to identify for you each time. Sorry about that.
Thank you, sir. You identified revenue neutrality as an important component of 86 and as part of this panel's charge. If we want to make changes to reform that lose revenue, that means we have to raise revenue in some way. And one of the panelists from our last hearing suggested that one thing to consider is a VAT. In other words, to make our tax system more like the European tax system, which has a couple of sources of revenue. I wondered what your views of that proposal might be. As you know, it's also been mentioned that that might be a source of revenue for entitlement reform as well. So I wanted to know your reaction to that as a possible option for reform.
Well, I think it is a possible option. I'm not an expert in how a value-added tax system works. We did not consider that in 1986 because we were purely and simply dealing with a reform of the income tax code. So we didn't get into that, and yet I think, given the mandate of this panel, it is something that you should look at. Just like I think, as I said in my statement, I think you should carefully consider the possibility of moving the nation to a consumption tax of some type that would promote savings and investment.
Our next panelist is Jim Poterba. Excuse me.
Thank you, Mr. Secretary. Looking back on the experience in 1986, are there particular pitfalls in trying to design a tax reform that you can alert this panel to and warn us to avoid? You've offered some broad principles that might guide our focus on the prize, but are there things, traps along the way that we should try to stay out of?
Well, I think there are some traps, and I mentioned a couple of them in my statement. If you're going to reform the income tax, I think above all else you must be conscious of political realities, because you're going to have to do it through legislation, and everybody wants a piece of the tax code for his or her own special interest. And I would recommend to you, if you're interested in it, a book that Alan Murray wrote at the time of the '86 tax reform effort called Shootout at Gucci Gulch. And that will give you a real vivid insight into what I'm talking about. I also mentioned the home mortgage interest deduction, because if you're going to reform the current income tax code, you will not get there if you think that you're going to be able to eliminate that deduction in order to somehow permit you to get the top marginal rate lower. These are the kinds of things I think you need to be aware of. We were disappointed in '86 that we could not eliminate all of state and local taxation deductions, because it would have enabled us to, again, to reduce the top rate a bit further. We were able to get some of it. We got I think, sales tax deduction and the ad valorem tax deductions eliminated. But we were not able to get the state income tax deductions eliminated. And to my way of thinking, and maybe this is because I've had a fair amount of experience in politics, this is a political exercise every bit as much as it is an economic exercise. I think it is important to set your economic goals, and I've mentioned some about revenue neutrality and elimination of the poor as much as possible from the tax rolls, a maximum marginal rate, things like that, and then proceed to put together a legislative group from both sides of the aisle that will support the prospect of reform. So I think you have to be very attentive to not just to the economic arguments, but also to the political ones as well.
All right. Well, next we'll go to Senator Breaux.
Good morning, Mr. Secretary. Good to see you and good to be with you. Although I gotta say that I prefer being with you down in South Texas hunting quail than where we are right now. But
well, I would enjoy that. I would enjoy that better too, John. We ought to program for that for this time next year.
I'm for that. I'd just like to pick up on one of the points you made. I mean, what you all did in 1985 and '86 was a remarkable achievement in the sense that you all were able to bring Democrats and Republicans together, and the panel that made the recommendations really just stayed with it until they got a recommendation that they could all agree on. I think that was the key to the success. Now, one of the things you mentioned was the commitment of President Reagan at that time to make it the centerpiece of what he was advocating in his second term. Now, it seems that the circumstances today is that the president has made Social Security reform the centerpiece of the second term, at least so far. So the question I have, given the parameters that we're operating in, is there a way to make tax reform one of those centerpieces? I mean, the question is, can Congress do two things at once? And I think that question is open for debate and for discussion. But I mean, we were talking tax reform here, and it seems like the administration is talking Social Security reform.
It's like when they asked Yogi Berra, what do you think about up there at the plate, Yogi? And he said, who can bat and think at the same time?
Yeah.
I certainly think that you can do two things at the same time, and you're quite right that the effort with respect to Social Security reform has already been launched and is underway, and it's either going to go or no go, it seems to me, before you really get this, before your report comes in, perhaps, and before the administration says, all right, here's the type of tax reform we're going to go with. But again, it's a function of presidential leadership, and there's still plenty of time in the president's second term for him to grab hold of that at the time your report comes in, make his choice, and lead the charge. So I don't think it's something that cannot be done at all. And you start in a little bit better shape, Senator, because while I've argued for putting as broad a bipartisan group together as you can, you do have a Congress today that is not a divided Congress, which I think gives you more potential for pulling together majorities in both bodies.
Thanks, Jim.
Congressman Frenzel.
Mr. Secretary, thank you for your wise counsel. With respect to the Senator's comments, it isn't always the greatest thing to have all your guys in charge, because as I recall in '86 we had a slight hiccup with the Republicans in the House when the rule was voted on and defeated, from which difficulty you were quick to react.
I remember that. I remember that very well, Congressman.
I was one of those fires you had to put out.
That's right. In fact, there were a lot of people on our side of the aisle that fought us tooth and nail.
That is true. But with respect to that, of course, this commission reports to the President. The President will report something to the Congress. And obviously, we have to be careful not to have our recommendations irritate any particular party or group in the Congress, but it seems to me we will be aided if we can go to statesmen like yourself in both parties as we develop our suggestions, and perhaps if we will be lucky enough to gain support, that will be helpful, and the Congress will have to work out its own arrangements as they did in your day. Is that a possibility?
Yeah, maybe it'd be a good thing.
I think it is, Congressman. I think that fundamental tax reform is so important, and it is also so difficult, that you will get the support of people who have been in this arena before. I mean, you'll certainly get mine. I know firsthand how tough it is to do this, how tough it is to come up with something that is pro-growth and fair and simple. And as I mentioned in my opening remarks, I hope you'll take a look at this question of a consumption-based tax. Now, that's a very broad step to take. But in my opinion, you can design something that would meet the tests of simplicity, of fairness, and of pro-growth.
Thank you very much, Mr. Secretary.
Mr. Rosati?
Mr. Secretary, thank you for your comments. A lot of the complexity, probably the majority of it, actually is related to business taxpayers, both small and large business, as opposed to individuals. Could you make a few comments about some of the particular problems you faced and some of the options you'd say should be either considered or not considered with respect to simplifying the taxation of businesses of all types?
Well, Mr. Rosati, I don't frankly recall too much in regard to that. Today you have increased tax avoidance, I think, at the corporate level. you're going to be hearing from your successor as the Commissioner of Internal Revenue, as I understand it, later on today, and he could probably better answer that question for you. But corporate taxation is, it seems to me, the most complicated area of the code. And I found back in 1986, frankly, that there were some elements of that, even after they were explained to me, that I had difficulty in understanding. So I'm not much help to you on that subject, but I'll bet you the Commissioner will be able to.
Thank you.
Tim Murris?
Thank you very much, Mr. Secretary, for appearing today, and thank you for your service to America. Let me follow up on a question on the consumption tax. You mentioned you didn't consider the VAT, and let me just read you. There are other ways to do consumption tax, obviously within the context of an income tax by exempting savings. Chairman Greenspan told us this morning that, I'm quoting a sentence here, in 1986, tax reformers considered a consumption tax base, and despite arguments in favor of such a system, they decided to enhance the comprehensiveness of the income tax system then in place. He goes on to say circumstances are different today. I just wonder if you could comment on that choice that you made in 1986.
Well, we made that choice, I think, Tim, primarily because of our experience in 1981. We had, if you will remember, come into office when the top marginal tax rate was 70%. Uncle Whiskers was taking 70 cents out of every top dollar that a lot of taxpayers earned. And it was just not a sustainable, I mean, it totally destroyed incentives. So we reduced in 81 the top marginal rate to 50%. By the time I got over to Treasury in 85, we had discussed the possibility of further reductions in the top marginal rate because we had seen the generation of greater economic growth as a result of the tax reductions that we legislated in 81. And I think that's primarily the reason we went that approach as opposed to some consumption tax-based approach.
Thank you.
Jim, this is Connie. I think the question I want to go back to, in a sense, kind of relates to the role of the panel. And I'm trying to, in my own mind, address the issue, if you will, of the tension between being sensitive to the political realities, but at the same time wanting to be bold in what we do. There's part of me that says that maybe we really shouldn't play much of a political role, that that we ought to focus on what we think is the best tax code that we can come up with respect to the goals of simplicity and fairness and growth. So try to help me think through about your recommendation, if you will, with respect to how we should act as a panel.
Well, Connie, if I'm correct, the executive order that sets up the panel asks you to come up with 3 potential methods. And one of them has to be some sort of a reform of an income tax system. Now, if that's correct, if I'm not mistaken in that assumption...
Yeah, the only comment that I would make is that there's no specific as to the number, but it's suggested that we come back with alternatives, one of which has to be as you explained it. So
one of which has to be. Yeah. Okay, well, I don't know where I got the idea of 3. But anyway, you can certainly come back with at least 3 and maybe more. And I don't see anything wrong with laying out the pros and cons of each approach, including in the pros and cons your assessment of the political difficulty or ease of a particular approach. I think that could be helpful to the administration. They will, of course, make their own political judgments, as indeed they have to. And again, you heard me say, and I believe this strongly, that this is not just an economic exercise. like anything else, when you're talking about legislation, you've got to be, you've got to consider whether or not you think you can get it passed. It doesn't do any good to send something up and have it shot down. And in fact, it sets you back and hurts the effort. So I think it would seem to me you have plenty of room to say this system will do this, thus, and the other with respect to savings and investment, unless it is crafted in a way that makes it simple and fair. It will be extraordinarily difficult to get through the Congress. I mean, I don't know why you can't send your recommendations over to the White House in that way.
Jim, thank you for those thoughts. And as I indicated, at least in my mind, I'm trying to kind of find the right balance there. I mean, in this town, you can't be apolitical. But by the same token, I don't want us to be so sensitive to the political side that we make conclusions about what the Congress is going to do.
That's correct, and I totally agree with that, Connie. And that's in effect what we had to do in 1986. There were things we wanted that we couldn't get, but we really didn't know that, didn't find out exactly what those crunch points were until we sat down with the tax writing committees. If you recall, we had retreats with Ways and Means and Senate Finance, and we discussed this with representatives from both sides of the aisle in both bodies. And at some point it became quite clear mortgage interest was off the table, state and local taxes as far as they applied to sales taxes was off the table, but certain other things were in. And that's the way we went about it.
Well, again, thank you very much, Jim, for your input. We really do appreciate your taking the time to be with us this morning, and
thank you, Senator.
And also appreciate your ability to adjust your time as we work through our fire alarm here. Thank you very much.
Thank you for having me, Senator. I appreciate it.